Morning. Hopefully everybody can hear me. We're about 10 minutes out from starting, so we'll do a little bit of getting everything ready while you're waiting, but give us about 10 minutes. Thomas, will you change your name to Thomas so I'm not confused? And then I'm gonna share this. I'm gonna make you the host and then you'll have to share it back with me.
Good. I was like, I guess I'm Chelsea today.
Oh, I can do it.
Oh, okay.
Okay, and then I'm gonna make you the host. Okay, and then if you can share it back with me, then we'll get started here pretty soon. While we're waiting for a few more people to get in, who wants to tell me what's going on with rates right now? And what we wish was going on with rates right now? Anybody follow that?
The rates appear to be flat, and we wish they were going up tremendously by about 5%.
Oh, really? We do? Yeah, rates have kind of been flat. We'll see what Trump can do. I don't know what's gonna happen, but uh probably rates are maybe the least of our worries. I don't know how you guys feel about it, but if you've been in the business very long, rates are pretty good right now, I feel like. Most of my deals right now are in the fives, and so I like to see that. Um, what are your outlooks for 2026? Anybody want to tell me how they're feeling about 2026?
Gonna be a
Hopeful.
great year.
Hopeful? Is that Martha? I
Yeah.
like that. That's a good answer.
Yeah.
Who else was saying something? Hopeful and what?
Gonna be a great year.
It's going to be a great year. Okay. I always hope that the coming year is going to be better than the year before. That's always my goal. So, so that's what I hope for this year. And, you came to a CE class early in the year, so that's starting off the year right. Hopefully you won't have to be at the very last second stressed about whether or not your credits are being banked. You'll just be all done early. So that's kind of what we're hoping for. I do 2 CE classes a month. Most of the time I teach it. I know some of you probably work with James Roberts, and I've started teaching most of the CE classes. Uh, Sometimes if I'm out of town, there's one in February where he's going to teach for me, but for the most part, I'm teaching most of the C classes now. So you get to see me and talk to me. But I really enjoy it. And I've been in the business for 6 years now and love helping people get houses and love working with all of you amazing real estate agents. So thank you for coming. Okay, we're 1 minute away and then we'll get started. And there was 100 people signed up and we've got 26 people here so far. So I'm assuming some people will be coming a little bit late, which is fine. Okay, let's go over credit really quick and then I'll go over it again in a couple slides just for the people who are a little bit later. The idea is that if we keep doing Zoom classes, the state wants us to have a way to be able to regulate whether people are paying attention or coming or not. And so this is our way. You need to have your cameras on if you have a camera. So please turn on your camera. We don't care how you look or if you did your hair today or any of that kind of stuff, but they like you to have your camera on. So please turn your camera on. And then you can either scan the QR code, and I don't think I've shared it yet, have I? Okay, Thomas, it said I shared a request. Okay. Okay, so you should be able to see the QR code now. You can either scan the QR code and fill this out as we're going along, or if it doesn't work for some reason, you can always email me and just include your license number. We can look it up, but it helps us if we don't have to. Your license number and then your 5 keywords. So you can write them down and then do this at the end. I'll put this up at the end again, but just make sure you're paying attention and keeping track of those keywords so that at the end you're not like, I didn't know I was supposed to keep track of the keywords, and then we are all sad. So that's what the state's requiring, and I really do appreciate it. I know some people don't love Zoom, but I really appreciate Zoom and being able to do that. It used to be all your CE classes had to be in person, and this saves us a lot of time in traveling, I feel like, and being able to take CE classes that people are teaching far away. So I think it's a great thing. Okay, so we're here to talk about 1031 exchanges and how you do them, what are some of the rules that you might not think about, how to prepare for them when your clients come to you and say that they're doing it, they want to do a 1031 exchange so that you know what properties qualify, what don't, who they should talk to, and you can give them good advice when this is something that they need and want to do. It has been talked about that this may go away at some point, that the IRS may not allow it, but we're still gonna just ride this wave as long as we can, because basically you're kicking the bucket down the road and kicking that tax amount down the road and not having to pay taxes unless you sell and don't reinvest. So, oh, and Preston thinks holding steady despite anything the Fed has done. Modern efficiency. I'm just looking at the chats, and there's all this AI stuff that's making me crazy. Okay, let's start with the rules. So the IRS has rules. This is all about taxes. So not having to pay taxes. And when you think of a 1031 exchange, that's basically what you're trying to avoid is taxes on your gain. So you bought a property, you want to sell it, you don't want to have to pay taxes on the amount of appreciation and equity and all the things that you've gained in the property. And so you're going to buy something else, like kind structure, and put that gain back into the next property and avoid paying taxes as long as you can. So no gain or loss is recognized where property held for investment or productive use in a trade or business is exchanged solely for property of like kind, which is to be held for investment or productive use in a trade or business. So what is like kind? I have people call me and say, I want to do a 1031 exchange on my primary property.
Nope.
Can you do a 1031 exchange on a primary residence?
No.
No. So that's the number one thing that you want to realize with 1031 exchanges. It can only be done on investment properties. Now, there's also some confusion about like kind. What does that mean? So let's say that I have a 20-unit apartment complex and I want to sell it and reinvest it with a 1031 exchange. What kind of property can I buy?
Multifamily.
Okay, multifamily is one idea. Anybody disagree?
Or just rental, I guess.
So you can buy whatever you want as long as it's an investment property.
Yeah.
Real estate, land, you can buy a business, a business property, a commercial property, you can buy another 20-unit property. You could buy 10.
A riverboat.
A what?
A riverboat.
Yeah, that gets a little bit like not land oriented.
As long as it's moored.
As long as it's moored.
It's moored, like
Yeah.
anchored?
Anchored, yeah. Yeah, so he's trying to trip me up. Thanks, Patrick. Appreciate you. But yeah, basically, sometimes we think it has to be a 20 unit for a 20 unit, but that's not true. You could buy a bunch of townhomes, right? It just needs to all equal the same amount or more. Okay, so don't get stuck on like, I'm selling an apartment complex and I want to buy some houses. That's fine. It's real estate for real estate. Okay. IRS section or IRC section 1031 provides, that's where the name comes from, right? The section of the IRS, the rules is 1031. So provides an exception and allows you to postpone paying taxes on the gain if you reinvest the proceeds in similar property as part of a qualifying like-kind exchange. Gain deferred in a like-kind exchange under this section is tax deferred, but it is not tax-free. So don't get confused with you never have to pay taxes. It's just we're deferring the taxes until we get to a point where they are required. And a lot of people, they keep deferring the taxes and then they end up passing away and giving it to their kids, and then their kids can sell it at fair market value and not have to pay taxes on it. And so that's kind of what people are trying to do usually. But eventually, if you sell it and don't reinvest it, you're going to have to pay some capital gains. Okay, common misconceptions. Let's go over these. 1031 is not a loophole. So don't think of it as a loophole. It's just a way that we can push taxes down the road. You must swap properties. So remember, like kind for like kind, real estate for real estate. Exchanges are a new thing. Section 1031 was adopted in 1921. So first exchange in 1976, approved in 1975. So it's not brand new. It's been around for a while. Talked about the definition of like kind. That's one big misconception that I hear. And then the other one is that it has to be an investment property. So don't try to do a 1031 exchange on a primary residence. Only for large investments of the wealthy, that's not true, right? Anybody who has an investment property can do a 1031 exchange. Complicates the transactions. A lot of times you'll see real estate agents not love the 1031 exchange addendum. It's not going to be complicated. They just want you to know what they're trying to do because there's deadlines that they have to meet. And if they miss them even by one day, they're going to be paying a lot of taxes. So that's a big thing for us to realize as, real estate agents, lenders, when we're talking to people about this, that we don't give them bad ideas about when, the deadlines, and we'll talk about those. The 45-180, we'll talk about that, William, when we get to that point, when we talk about the deadlines and some of the rules about that, because it's a big deal, right? So it's like even one day, I mean, there's really no exceptions to it. And so you really have to watch those deadlines. Let's see, expensive to complete, around $1,000 to sell and purchase. So we're not talking a lot, but we will talk about that you do have to have an intermediary and somebody outside of just a regular title person to help you with the transaction, to hold the money. And you want to make sure that you're super careful and vet out those intermediaries, that you don't just give your money to anybody who says they are an intermediary, but that you vet that out so that you're not have any problems with that. We'll talk about some things that have happened with money that's been held like that in escrow, and it gets a little scary. Okay, for anybody who joined a little bit late, remember you have to keep track of my 5 keywords over the course of the class. You can scan the QR code or email those words to me after the class, but make sure you're keeping track of those words. And we usually give the first word about 15 minutes in. Okay, so there are a lot of benefits to the 1031 exchange. Immediate tax deferral, we've already talked about. Greater buying power or leverage, right? You can move into a bigger house with that down payment money without having to pay taxes on it. Increase your income or cash flow, management relief, diversification or consolidation. So that one we kind of talked about already a little bit too. If you take a 20-unit property and then you buy 10 townhomes, right? You can now all of a sudden you have a bunch more different properties. Or if you take a bigger house and no worries, Andrea. If you take a bigger house and consolidate into a smaller house, you can do that. You may be paying a little bit of taxes, but you can defer some of the taxes. So there's just a lot of different ways. We're going to talk about the basics today, but there are a lot of different ways. And when you get to that point, find a good intermediary and go over everything with them as well. Okay. You'll hear people say sometimes swap till you drop, right? That term of like keep swapping till you're not here anymore. But basically you step up your basis every time you purchase another property. And don't assume your clients have talked to a CPA. I would always recommend you as real estate agents, when you're giving advice to your people who come to you and say, I want to do a 1031 exchange, I want to sell this property and buy another one, make sure they've talked to their CPA. They know you're not going to know the basis. Try not to give them any advice about, the CPA. We know the basics, but make sure they're talking to their CPA about really what their tax implications are, and make sure they're talking to an intermediary about all the rules and their dates and their deadlines. Okay. Do you need to put 1031 exchange language in the contract? Who's done a 1031 exchange? Jeff, what stuff do you have to put in the contract?
So there's an addendum for a 1031 exchange, and it's pretty simple. The other agent, so if I'm on the buying side, the other agent wants to see evidence that the exchange is either occurred or about to occur. If you're doing a reverse exchange, I'm sure you'll talk about that. That's a little bit different, but
Right.
yeah, there's an addendum that needs to be filled out and agreed upon with the seller and buyer.
Yeah, so whoever's doing that 1031, because if you're selling it, right, then you're going to be on the seller side when you sell the 1031 property. And then when you buy the new one, you're going to be on the buyer's side. So when you submit your offer, just submit that 1031 exchange. When you are on the seller's side, then just send that over to the buyer so they know that you're doing a 1031 with the property that they're buying. So there are times when it's too late for a 1031 exchange, and you have to be careful. And sometimes people don't realize this or haven't talked to an intermediary, and they sell their property and close it before they talk to the intermediary and get the 1031 started. It's too late at that point. Once you've closed on it, you don't have the opportunity to do that. And so make sure that before you sit down to the closing table, if your sellers are doing a 1031 exchange, that they've already talked to the intermediary, and they've, they can start picking their properties, they've started their timelines, all those things, because once they've signed and closed on the property, if they haven't already indicated that they're doing a 1031, it's too late. So I have taken a class about a 1031 exchange, and an intermediary was the one that did it. And she said there have been times when they're sitting at the closing table and they're like, we haven't done that. And that she's like, it's possible, but it's not what you don't want to be at that point. So I think it's a good idea to ask, and maybe you guys already do this, to ask, are you going to 1031 this property, right? If you know it's an investment property, that's a good question to ask. If you know they're living there, then you know they can't. But if you know it's an investment property when you're on the seller's side, that's a good question to ask them. If you call your intermediary from the closing table, you can usually still make it work for them, but don't do that. If the funds have been received by the taxpayer, it cannot be unwound. So if any funds come to you, even if you've already told your intermediary, even if you've already started it, if any of the funds come to your account, you can't unwind that, and you're going to be paying taxes on that. So make sure that your people understand when they're doing a 1031 exchange, they're not going to get their money it's just going to go from the intermediary to the new title company to pay for it. If they get any of their money, even if they want to give it back later or use it, it can't be unwound. Okay, capital gains. Let's talk about what capital gains are real quick for some of you. What's a capital gain? You can have it not just with real estate, right? So you have capital gains on your taxes for other things, but what's a capital gain?
Growth after basis.
Okay, so in the case of real estate, you purchase a property for 300,000, you sell it for 350. What's your capital gain?
50 so far.
Okay, now Jeff says so far because what if you've made capital improvements on it? What if you've done something to it, right? So those can be added to your basis, and then but what's a capital improvement? That's something to talk about too.
Any upgrades or improvements, I think.
Okay, so capital improvement, oh, my eyes are watering and I don't know where my tissues are. Capital improvement is something that's gonna last a while. I usually like to say that, for lack of a better word. So not maintenance, okay? So maintenance wouldn't be a capital improvement. It would just be maintenance, right? But you can add things like a new roof. You can add things like, you redo the whole kitchen, right? Those are things that are going to last a long time. And so just to recommend they talk to their CPA again, right? Because you're not going to know what their basis is. But the idea is that you know the basics of what a capital gain is, and they're going to talk to they're going to know all their capital gains. Now, you have to subtract depreciation, because when you have an investment property, depreciation is just a paper deduction, right? And so when you sell it, you're going to have to minus that depreciation back out of it and basically pay taxes on your depreciation that you've subtracted over the years. So, so just be careful of that, but that's not your responsibility to know. Their CPA is going to know that, but it's good for you to kind of understand what a capital gain is. Now, you can have capital gains on other things, and I run into this as a lender. People want to, well, I made $50,000 last year on my stocks. Okay, well, we usually don't count capital gains because they're not, like, you might have done that one year, but then the next year you're not. So we usually don't use that as income. It's tricky, but people do make money in other ways. And there's long-term capital gains and there's short-term. There's a lot of different things about capital gains, but just know that maintenance is not capital improvements. and know that basically your basis, what you bought it for, minus what you're selling it for is your capital gain. These are just tax stuff. Your CPAs are going to know about this, but basically capital gains is a lot more than just income taxes. And so that's why we're trying to avoid it. It can be very expensive if you don't do this right and you end up having to pay capital gains. And I know when you're selling a property, even if it's a primary property, be really careful what you advise people. I know that I've had real estate agents advise them to sell before their 2 years, and then they ended up with capital gains. Anybody know what I'm talking about there? Primary residence, 2 years. What's the magic number?
So 250 for an individual and 500,000 exemption if you're a married couple on the gain.
Right. So if you have lived in it 2 out of the last
Years.
5 years, and that can be, like you have to live 2 out of the last 5 years. So you could have turned this into an investment property, but have lived there and sell it and still get that exemption. But 2 out of the last 5 years. And, if you sell a primary residence and you've made a lot of money, say like 2020, and you've made a ton of money and you sell it sooner than the 2 years, you're going to be paying capital gains. And so be careful when we're advising about tax things. Always have them talk to their CPA. I've had people sell just a day early or 2 days early when they could have pushed it past, and it's really expensive.
On those CPAs too, I always advise clients to find one that actually understands the 1031 process, because there's a lot of CPAs that aren't really that in depth on it. And so they're looking up information or old information, and they're really not keen to the active 1031 rules. And that can become a problem later if you're not careful.
That's really good advice. I've heard people say that they paid taxes when they shouldn't have, and you're right. So make sure you have a reputable CPA. That's fair. Okay, short-term versus long-term gain. Short-term is 1 year or less. Long-term is 1 year and a day or more. And the short-term gains is just a higher rate than long-term gains. So we're not going to spend a ton of time on taxes and things like that. That's more of a CPA, but just know that 1 year, if they've kept their investment property for at least a year or more, they're going to be in the long term. So if they're close to a year and they want to sell, they may want to consider waiting till after a year because they're going to save taxes even if they're not going to 1031 exchange. Okay, I'm going to skip that one. Yeah, so we have a Medicare tax and it goes away if you make a lot of money. I'm not going to worry about that. State tax on the gains. Tax rates vary from state to state. So if you're working with somebody who's selling something in California and buying something in Utah, be careful. There are some states that have clawback provisions, California, Montana, Oregon, Massachusetts. So there's a few. So just be careful because it can be a big deal. I had somebody just sell a property in California and move to Utah, and they were super worried about the tax implications from state to state. Some states just have different rules. Many simply follow the federal code, but there are some states that have no income taxes. So it's just different. Just be careful not to advise people on things you don't know about. Taxable sale versus a 1031 exchange. Taxable sale equals high tax burden. Portion of the investment lost or unrecoverable. Section 1031 equals taxes deferred. We've said that already. Fully leverage the strength of the investment or the equity to create and grow wealth, more buying power. Okay, let's do our first word and do 1031 exchange for number 1. Our first word is 1031 exchange. Okay. Let's talk about boot. This is kind of important because you can keep some of the money, right? So you don't have to reinvest everything. You can decide, what, I need $10,000 for a medical bill or whatever, right? You can decide it's your money and you don't have to reinvest everything. But just know that whatever you don't reinvest, they call it boot, is taxed. Okay, so that's the part that's getting taxed on, and we're going to talk about cash boot and mortgage boot, both. So when you do a 1031 exchange, you need to put all the cash back in, but you also have to have a mortgage that is equal to or greater than what you had before. So keep
Excuse-
that in mind.
Hi, can you hear me?
Hi, yes,
Hi,
Paige.
it's Paige. Yeah, can you repost the QR code
I
for me?
can.
Thanks.
There you go.
Okay. I don't know why my Zoom is not, it just went to Zoom instead of, sorry, I'm trying to.
You can't see it?
No, I'm trying to pull the whole screen back up. It just says Zoom instead. So,
Can everybody else see it?
Maybe add a link in the comments. That might be an easy way to get around that.
Oh yeah, Thomas, have you added a little link?
I'm having problems too. My Zoom keeps shutting down.
yeah, it's like the window's up, but the
Okay.
Zoom is shutting down.
That's super weird. I don't know. Mine hasn't said anything about like unstable connection or anything. I don't know.
Linking in the comments will make it really easy for everyone, I hope.
I can't even get into the comments.
Oh, you
Oh,
can't.
yeah.
Maybe,
I just had to put in
Maybe-
just the audio on
maybe
my.
go out and come back in
Okay, I'll do
and
that.
see.
Okay, I'll see you in a sec.
Okay.
Can I ask a quick
Oh,
clarification?
there we go. I'm back in.
Please.
So you just said that the mortgage on the new place has to be equal to or more than what you've sold. But you were talking about like the 20 unit building and then buying 10 townhomes. They just have to add up to more.
Right.
Okay.
Right. So if you had a mortgage that was 100,000 and then you bought a few places and had a $20,000 mortgage, you'd have to have 5 of those or 4 of those or whatever. Yeah, 5. So you can go, and there's lots of rules, and we'll go over those because there's different rules. Once you get to the intermediary, then you decide kind of, okay, I'm going to buy 3 properties, or I'm going to buy 10 properties, or whatever. And so you have to be a little bit careful, but we'll talk about all those rules too.
Eden,
Yeah.
sorry, same vein. So is it the original mortgage amount or the amount that's left on the mortgage that it has to be more than?
The amount that's left.
Okay, thank you for that clarification.
Okay, let's see if I know where I was.
Boarding in progress.
Murder. I should have kept track of where it was, which number I was on. I think we just did boot, right? We have an echo somewhere. I don't know. Yeah. If you're not talking, if you can mute. But then I want people to comment, so I appreciate your comments. Okay, so let's talk about boot. And you can always email the words too, so feel free to email the words at the end. Okay, general rules to defer gain. Equal or greater value. So let's say that your property based on the net selling price. So less allowable closing exchange expenses. And not everything can be taken out. So that's another cue, like working with your intermediary. But basically equal or greater equity based on the net equity. Tax on trade down in value or equity or boot. And debt relieved must be replaced. So the new mortgage or fresh cash or a combination of the two. I know that kind of seems confusing, so let's just kind of do some examples. Exchanging for equal value and equal equity. So the property that you sold has a value of 300,000. The current loan on it is 100,000 and the equity is 200,000. The replacement property, the value is 300,000. The loan's 100,000 and you put the 200,000 down. That's just equal for equal. And that's fine, right? There's no boot. You can do equal for equal too. So equal or greater than. Exchanging for reduced loan but equal equity. So if you have a relinquished property, again, 300,000 value, the loan is 100,000, the equity is 200,000, your value on the new one is 300,000, and you put down 200,000, right? The reduced value doesn't give you boot, but it's not allowed. So if you don't have a loan, so the reduced loan but equal equity. Okay, so if, let's say you put $100,000 cash, so you didn't have a loan, right? Then now you have 100,000 in boot because you have a mortgage boot. But you might want to do this, right? Because you might want to take that 100,000 and do something else with it, but you're going to be paying taxes on that mortgage boot. Okay.
So in that situation, why would you why would you take boot if you already had 100,000 in cash? The scenario doesn't make sense to me.
Yeah, it doesn't. So to me, I think in this case, they just want to make sure you understand that you have to have a loan the same amount. So you're going to take that loan out, right? And you're not going to do that. You're right. But they're just trying to say like you don't want to, you just have to have the same loan on the property and you have to have all your equity put down on the new property to be able to really transfer your gains to later.
Do you have to hold on to the replacement property for a certain amount of time?
Well, so let's say you sell it in a year, you're going to be paying capital gains, right? Short-term capital gains. If you keep it for a full year, then you'd be paying long-term capital gains. But you could sell it and then 1031 exchange it again. Within that shorter period of time. It's just if you don't 1031 exchange it, then you would have to. Yeah, good question. Okay, qualified intermediary. The final Treasury regulations of 1991 defined the role of the qualified intermediary, or QI. The QI's function is to work within the procedural restrictions of the IRC. So they know all those rules, right? Like I'm giving you basics, but make sure you're always working with a good qualified intermediary that's vetted, that's insured, all those things, right? And then also, like Patrick said, a good CPA. They must not be the taxpayer or a disqualified person. So you can't be your own qualified intermediary. If somebody asks, well, I'll just be my own. You can't be. There must be a written exchange agreement. And that's what we're talking about, signing with a QI before you close on the
This meeting is being recorded.
There must be strict control of funds while on deposit. Again, remember, the qualified intermediary is going to keep all those funds. Once you sell your house and close on the relinquished property, all those funds are going to go into their bank and they're going to keep them. You don't want to use any of the funds while you're working on buying the new house. Don't ask them, give me just $20,000 and then I'll give it back to you and I'll put it down again. All those funds have to stay there. And so that's something that sometimes people don't understand. And sometimes it takes a while to find that next property, 180 days. I mean, that's 6 months, right? So there must be, and once you're set up with a QI, you can't change it. So make sure you like the person and that they're not a disqualified person, that you haven't signed with somebody that can't. But someone who's considered an agent of the taxpayer at the time of the exchange, family members or related persons, those are disqualified. So just be super careful and make sure they know who to talk to so that they get a good person to work with. So who's holding the money, right? I told you I would tell you about some bad things that have happened, but during the time when the stock market was going crazy, there was some companies who in their exchange contract, they said they had put in small print that they could reinvest the funds. And so they put all this qualified intermediary funds into the stock market and then it fell apart and everybody lost their money. So be super careful to read contracts and know what people are doing. And a lot of these qualified intermediaries have disappeared, right? So be careful. You can look all that stuff up about that. How to choose a qualified intermediary, financial strength of a qualified intermediary. To the QI, you're dealing with how the financial backing of a larger company or corporation. Are the QI's books audited on a regular basis? What type of oversight is there put upon the QI? Does the QI have a fidelity bond or E&O insurance? So those are good questions to ask and find out. There's a lot of good ones out there, and you can ask lenders or title people who they have and who they use and who they work with.
Also well established, like a track record that you can confirm. And then the other thing, some of the intermediaries are so good about communicating with the buyer or seller side to like let them know about dates that are coming up. And I really appreciate that. So we'll all be like on the same email thread. And I'll say, well, here's where what we're doing, and we've identified the property, and this is the intermediary that we're going to use, just so you're well aware. And then, the better ones will reach out and say, sure, let me help you out if you need any other additional information in your purchase or sell. And that, I think just that little added touch really does make a big difference.
For sure, just like any contract you're in, right? If the title company's saying, we're coming up on our due diligence and emails that
Yes,
to everybody, or we're coming
that's
up
just
on
it.
our finance and appraisal. Yeah,
You're absolutely right. And that just sending a reminder out, then no one can say, oh, well, geez, we didn't really understand what this date meant or when this, because like they will confirm multiple times, hey, we're 1 week out, or we're 5 days out, or we're 48 hours out from what we need to do. And it may be a redundant thing, but for just to have an extra set of hands typing that in and just sending out another reminder, I think can make these transactions go so much more smoothly.
for sure. Yeah, for sure. Thank you. Okay, so fidelity bond and errors and omissions insurance. A fidelity bond is a form of protection that covers policyholders for losses that they incur as a result of fraudulent acts. We talked about that. There are fraudulent acts. And I really appreciate Patrick's talking about, like, you want to make sure it's well established, because I don't think there's super big rules about being a qualified intermediary. And so there's not like, I think anybody can just start being a qualified intermediary, right? And so you want to be super careful that they've been established and that they've been around for a long time, because here's all this money that's sitting there, right? You don't want them to be using it for other things, and they shouldn't be. And you want to be careful. It's a lot of money. Errors and omissions insurance protects business professionals whose clients could claim damage as a result of the business professional's faulty performance. Faulty performance may be because of negligent act, error, or omission by the professional. Okay, like Patrick said, these dates are a big deal. You can't miss the dates and the deadlines. It costs people lots of money. Okay, qualified per regulation. Is your qualified intermediary disqualified for the disqualified parties? Remember, like if you're related, things like that. And if you're doing exchanges in some of these different states, is your qualified intermediary in compliance with those state regulations? Okay, we talked about this. What qualifies? So let's talk about it again one more time. I'm selling a house and I can buy for 500,000. I can buy 2 houses for 250,000. I can buy 2 townhomes for 250,000. I can buy a condo project. I can sell something in Utah for $1 million and buy 10 townhomes in Texas. So there's unlimited things that you can do. We talked about like-kind requirements. Remember, real estate for real estate. Single family house for raw land, apartment building for a retail center, office building for a warehouse, fourplex for a TIC interest in an office building, tenancy in common. Okay, there's just really unlimited options. Talked about that. Okay, both the relinquished property and the replacement properties in a 1031 exchange must be properties held for productive use in a trade or business or for investment. General terms used for 1031 property is investment property. But again, it can be a commercial property space too, right? So real estate for real estate. Personal residence does not qualify. We've talked about that. Stock in trade does not qualify. Partnership interests do not qualify. So I had somebody a couple years ago call me and say, well, me and my husband own this house together. It's investment property. We're now divorced. I want a 1031 my side and he doesn't want to. Okay, you have a problem, right? Tenants in common, you can't just 1031 your side. So be really careful with partnership interests, percentage interests when you have properties. If you're trying to sell and they want to do 1031 exchange on it, you might have to change the way they hold title before they do that. So asking them how they hold title and talking to a title company about 1031 exchanges and talking to a qualified intermediary before you get the property listed and some of those kinds of things. So just be careful with how they hold title because that can cause problems sometimes too. Both partnership interest, general liability are excluded from 1031 exchanges. Check with your qualified intermediary if you have a partnership interest or your CPA. So just be careful about how they hold title. Sometimes that can cause problems. But I did, once I had that question, I did talk to a qualified intermediary, and she said you can kind of change the way that they hold title a little bit before if you really need to work on that. So just talk to somebody to do that. Vacation or second homes, revenue procedure, safe harbor for exchanges of vacation homes and conversions to or from personal residence. The vacation home qualifies if you own the home for at least 2 years, rent it for at least 14 days for each 12-month period, and your personal use was no more than the greater of 14 days per year or 10% of the total nights rented over the 2 years leading up to the sale. So there is a possibility that you could 1031 exchange vacation and second homes. Basically, just switching your second home for a second home without having to pay it. But be careful. If you own a home and rent it for fewer than 15 days, you don't have to report the income. However, the IRS considers the second home an investment property if you spend less than 2 weeks in it. So when you've had somebody buying a second home, this is why the lender will say, well, you can rent it out when you're not there, but you have to spend at least 14 days there yourself. Otherwise, it's just an investment property. And the difference between a second home and an investment property is you can put less money down. So a second home, you can put 10% down versus an investment property where you're putting 25% down, right? And so sometimes people have this, well, I'll just buy a second home, but it's really an investment. Okay, well, you need to be there for 14 days. So anyway, that's just some of the rules about second home and vacation properties. What's considered personal use? Taxpayer or their families, anyone if rented for less than fair market rent. So if you're giving somebody a deal or they're just paying for the cleaning, that could be personal use. Okay to rent to a family member if the unit is used as a principal residence and fair market rent is paid. If used additional days for repairs and maintenance, be ready to show actual work done. So just keep receipts and things like that if you're working on a place so that you can prove that you are actually doing work on it.
Can I ask a quick question on that?
Sure.
So let's say I bought a home and I'm going to Airbnb it, but I use it for at least a month out of the year. So that would still work, would it not?
Right. So that's a second home versus an investment property.
So then you only need 10% down in order to get into it.
Yep, get into it. Yep. And this is the biggest thing about buying investment versus second home too, as far as qualifying. It's much easier to qualify for an investment property. Why?
I'm not sure why it's easier to qualify for the investment property.
So number one, your payments can be a little less, right? You're putting 25% down. But if you're buying an investment property, I can get a schedule of rents from the appraiser to offset the payment when you're buying it, right? Because it's an investment property, you're not going to live there. You're going to get a 12-month lease to pay it, and I don't have to have that 12-month lease when you're buying it. I just have to have a schedule of rents from an appraiser saying what it would rent for. Now, do I want to know that you're going to Airbnb it? That gets to be like skirting the line, right? Because if you're going to Airbnb it and you tell me that as a lender, we're not going to be able to offset the rents anymore. Because it's not a long-term lease agreement, right? And so if you come into me and you say, I'm buying this investment property, I'm putting 25% down, I'm gonna Airbnb it. And I'm like, okay, well, I hope you qualify for that full payment because we can't offset the payment. If you come to me and you say, I'm buying this house and I'm gonna get a long-term lease and I'm gonna rent it out to my family, great. or I'm going to rent it out to somebody for a 12-month lease, great. I'm not going to need the lease in that case, but I'm going to be able to get a schedule of rents and offset that payment. You can't do that on second homes. So you have to be able to qualify for the full payment on a second home because it's going to be an Airbnb if you're going to use it for anything else, because you can't do a long-term lease and then use it for a month yourself. So, so that's the difference. And I know that people can make more money Airbnb, but if they tell me that, then it makes it hard for me. Okay.
There's also a trick. Oh, sorry, I didn't mean to interrupt,
Go
but
ahead, Patrick.
I've also seen a couple problems like recently in the avenues where people had run Airbnbs successfully and then neighborhoods clamped down on it because there was like parking problems and just in and out. So like well into a year, what was working out wasn't all of a sudden. So that can also get really tricky fast.
Yeah, if you buy something as an Airbnb and then you all of a sudden the rules change and you can't Airbnb it, it makes it hard.
Yeah.
Right, right. And there's been a lot of that that's happening. Like I know that's a big deal in Hawaii, like over the last few years. And so yeah, it makes it hard. So yeah, you have to prepare for what could happen and make sure that like when you're buying a property, if you really do plan on Airbnb-ing it, that that's allowed in that neighborhood too, right? And do your due diligence. Okay, this is the 121 exclusion that we were talking about for primary residence. So don't get those confused with 1031 exchanges, but this is something that's really good to know. It's a 2 years, right? So it's not 1 year and 364 days, it's 2 years. So be careful when somebody's selling their primary residence that if they're really close to that 2 years, that you let them know that, because they wouldn't want to sell that early if they were really close to that and have to pay the gains on it. Now, maybe they're not making anything over the last 2 years as much as they have been once they pay their real estate fees, but just be aware of that. So 250 for a single person that they can exclude and not have to pay gains on, and 500 for a married couple. And they have to live there 2 out of the last 5 years. So if they've moved out of that house, that doesn't necessarily mean that they won't qualify for that exclusion. If they've lived in it 2 out of the last 5 years. So yeah, possibly these could be combined because you could exclude some of the gain and defer the rest. If you, let's say you bought a house, lived in it for 2 years, moved out of it, lived in somewhere else for 2 years, and now you're selling it. Now you have an investment property and a primary property that you could use both, right? You could defer, it's been an investment property for 2 years, it's been a primary for 2 years, and you're selling it, you've got, 121 exclusion that you can do, and then if there's any extra, you could 1031 defer it too. So that is possible to happen. Mixed use properties are combined use properties, personal use and investment. So for example, something like a storefront with an apartment above it, those are mixed use. The investment portion can be exchanged, but not the primary portion, right? Personal residence portion can be excluded, and then you could defer some of the rest of it. Examples: working farms and ranches, bed and breakfast, duplex, significant acreage attached to personal residence. So these get a little more complicated, but again, qualified intermediary is going to be able to help with all the exact things. You don't have to know everything about it, but just the basics. Okay, let's talk about time frames. Let's do our second keyword. We have about 45 minutes left. So our second keyword is going to be, let's do boot.
Can you resend that QR code again? Sorry.
Yeah, let's try it again and see if it works.
Okay, thanks.
You can click on, I don't know if you're on a computer, but you can click on the link in the, see if you can get into the, you only need 4 out of the 5 keywords. So if you miss the first one, don't stress, just get the next 4.
Eden,
Yeah.
I wanted to jump in and let folks know if you try and do a B&B in Daybreak, it is a nasty fine. So that just goes along with what you're talking about, making sure that, it's possible in the area that you're in.
Yeah, okay. Daybreak is its own creature for sure. So did you try to do that?
No, but I've sold about 90 homes here. So I follow the rules closely.
Good. Okay. Yeah, it really is a good idea no matter what you're trying to do to research everything super well. And things can change, like Patrick says, right? Like even if you've done your research now, things can change afterwards. So that can be hard too. Okay, Paige, did that work?
It did. It did. Thanks.
Okay, and there is a link in the chat too.
I can see that. Thanks.
Brian, you're right. Buying in Daybreak has been a disaster. Okay, I love Daybreak though. My friend lives there and but yeah, it can be. They have a lot of HOAs and a lot of the properties have 2 or 3 HOAs. I've done a lot of deals and there's a lot of people to work with in
It's
Daybreak.
not a disaster. You just have to know what you're doing.
Fair. And you have to work with all the different HOAs and make sure that you know what's going on with them. I said I was gonna watch when I went back up to the top and remember which one I was on, which slide.
It was 41.
Slide 41.
You guys are better than me. Thank you. Okay, so let's talk about our time frames. So let's say you sign with an intermediary, right? And now the clock starts ticking. And usually it's when the closing of the relinquished property is day 0, okay? So then day 1 is the day after the closing of the relinquished property, which is why you have to know that you're doing the 1031 exchange before you actually close on that property, okay? So let's say you closed on the relinquished property, the next day is day 1, and you have 45 days from that relinquished property closing to identify your properties. Once that 45 days is up, you can't identify any more properties. So you're buying one of the properties that you identified, or you can't do a 1031 exchange. Okay, and then you have to close by the earlier of 180 days or the due date of your filing federal income taxes. So let's say that you identify a property in December, right? And then your taxes are due. So just be careful with that one. But what are you identifying in that 45-day period? So you just sold your house that you wanted 1031 exchange, and now you have 45 days to do what?
Isn't it just to say how many properties you're going to buy?
Yeah, and so choose 3, Paige, and that happened, like we're going to talk, there's a couple different ones, right? But most of the time you can identify up to 3, and we'll talk about times when you can identify more. But that's the typical one. And you're going to actually submit a form that says this property and this address, and here's the 3 properties that I would like to choose from. And why do we want to have more than one? Let's say we're just switching one house for another house. Right? You're going to go through the process of due diligence. You're going to be like vetting it, right? You don't want to just have one property. Yeah, it gives you options. You don't want to just have one property and then now like if that one didn't work for whatever reason, I mean, like you go under contract, you've seen people go under contract and then pull out at due diligence because of some big problem that they didn't know. So we want to have a few options. So let's talk
Even being
about
outbid.
Patrick.
Even being outbid in a hot market.
Right.
Like when it was nuts. I mean, I had one in Vegas that we were transferring to here, and we had to have the 4th option to re-identify because the first 3 we just were outbid, even though with our sell price we were willing to pay a lot more. We just got beat out 3 times in a row.
Okay, yeah, that's a really good point. So you might just not be able to go under contract on those ones, right?
Right.
You've got to have more than one. Good. Okay, so there are no extensions, even if day 180 falls on a Saturday, Sunday, or a legal holiday. So be really careful that we keep track of deadlines. You as agents, you're going to want to know when their 180 days is up, right? Because you're going to be helping them find a property. And while they should know and their QI should know, you're going to want to know so that when you put things under contract and you're watching the dates, that you don't miss that 180-day deadline with closing. Okay, so here's kind of an example of what you might fill out if if you're going to identify the property. And if you identify more than 3 properties, please see page 2 of this document. There's rules. So 3 property rule, 200% rule, and 95% rule. There's 3 different rules, okay? 3 property rule is the one most of you have heard about. It's the one that's most common. And we'll talk about the 200% rule and the 95% rule. But the taxpayer can revoke a property from their list of identified properties. There's no limit on how many times they can add or remove properties from the list, just as long as the list is finalized within the 45-day time frame. So you can add and subtract, and you can, end up with just 3, but everything has to be finalized within that 45-day period. Okay, the 3 property rule is defined under section 1031, which states that an exchanger or taxpayer executing a delayed exchange has 45 calendar days from the closing date of the sale of their relinquished property to formally identify a replacement property or properties. Under the 3 property rule, the exchanger may identify up to 3 properties regardless of value, as long as he or she acquires one of the 3 as the replacement property within the 180-day exchange. So, you still have the rules as equal to or greater than, you have your boot rules, but the 3 property rule is just you identify 3 properties and you have to buy one of those 3 properties within the 180-day exchange. So that one's pretty simple. If you want to identify more than 3 properties, you can, as long as then the 3 property rule no longer applies, the 200% rule applies and comes into play. So you can do more than 3 properties, but the 200% rule then comes into play. And this rule states that the identified properties aggregate value can't exceed more than 200% of the relinquished property's value. So if you have a property at 500,000, then you can identify using the 200% rule more than 3 properties, as long as it's not more than $1 million total aggregate. Okay. With the 3 property rule, you can still trade into more than 1 property. It can be all 3. So it doesn't just have to be 1. The 95% rule says that a taxpayer can identify more than 3 properties with a total value that is more than 200% of the value of the relinquished property, but only if the taxpayer acquires at least 95% of the value of the properties that he identifies. So if you want to, then you're like, okay, I'm up to $1 million, but now I have to buy something that is 95% of $1 million. So just, those are the rules, okay? And so sometimes, like what Patrick was saying, you might be like, I've got to identify a ton of properties because I might not be able to buy any of these, and you get nervous. But those are the rules if you do go higher than 3 properties. Take advantage of the time when the sales contract of the relinquished property is signed until the relinquished property is actually closes. So, you have 45 days to identify the properties from when it closes, but take advantage of the time when it's under contract and use that time to identify properties as well. It is okay for the taxpayer to enter into a contract on the replacement property before the relinquished property closes, so long as the relinquished property closes first. So just be careful of that makes sure that relinquished property closes the day before the new property. Otherwise, we're talking about the reverse, and that gets more expensive. Holding requirements. How long must a person hold a property before they can do a 1031 exchange? Length is not defined in the regulations. So I think somebody asked this. How long do I have to hold the property before I can sell it or 1031 exchange? And it's not really defined. The intent of the taxpayer at the time of purchase is key. IRS will look at facts and circumstances of the transaction. But either way, if you sell it and don't 1031 again, then you're going to be paying taxes on it. That's just how it works. But they're the same thing. There are rules, when you buy a primary property, you're supposed to live in it for a year, right? Is the intent, and you sign a paper that says you'll live in it for a year. But I've had people who haven't even moved into their houses and bought a new primary and kept it as an investment because of safety reasons. And so I had somebody who bought a property as a primary, and when she went to go move in, her mom slipped and fell and broke her hip. And there were some big dogs that scared her little dog, and she didn't feel safe, and she'd never moved in. And she called me 6 months later, and she was like, I'm not going to move into that house. I'm going to turn it into an investment property. And we had a letter written and just explained the situation, and she was able to keep it as an investment and buy a new primary. So her intent originally was to move into it. And so just know that there isn't anything specific, but remember, if you did sell it in that situation, long-term versus short-term games are more expensive. Was there a question? Nope. Okay. Cash out rules. When can the exchanger receive their funds from the QI? After the 45-day identification period, if no new property is identified. Because at that point, what's happened? They can't do a 1031 exchange anymore, right? They haven't identified the property within the 45 days. There's going to be no 1031 exchange possible. And so then the QI can give their funds to them. They're going to be paying taxes on it, but it's their money. And that can be frustrating to somebody, I think, once they sign that, because let's say they decide not to do the 1031, something happens and they need their money. Their money's stuck for 45 days, right? So that can be frustrating and has been for people sometimes. After the receipt of all identified replacement properties, after 45 days has expired, or after the expiration of the 180-day exchange period. Okay, so either one. Just why would a QI have concerns about releasing money when a taxpayer is willing to pay the taxes? It's their money. It's okay, Andrea. Right? They might have a concern that they might change their mind, and now they can't change their mind, right? So once the 45 days has actually expired, then they haven't identified a property. We know that they're not going to change their mind anyway. It's just one of the rules. So that's something that I would think that all QIs would tell people when they enter into the agreement. Okay, well, once your relinquished property has been signed and closed, then you won't be able to get any money, even if you decide not to do the 1031 exchange for 45 days. If a QI does not follow the G6 regulations, the QI could be considered an agent of the taxpayer, disqualifying the QI. Paige, yes, I will talk a little bit about the reverse 1031. If the QI repeatedly broke the G6 regulations, the IRS could deem the QI an agent of all of their, an agent of all of their exchangers, disqualifying all the exchange processed by the QI. And that would mean that all the people that they've helped even previously would have to start paying taxes. So that wouldn't be a good thing. Okay, title parking exchanges or reverse exchanges. Okay, let's talk a little bit about these. A reverse exchange is one where the taxpayer finds a need to acquire the replacement property before relinquishing the property. Why would this happen?
You don't have an offer on your primary.
Okay, so the relinquished property is not selling, but you found the property you want to buy. Good. So different markets are going to create different problems, right? For any buyers, sellers, for any of these kind of things. And there are markets where, okay, I've had the property I want to buy, but I don't have an offer yet. So you can do it that way, and it's just more expensive. It just costs more. And I don't know why it costs more, but that's what, in all the classes I've taken, it's just $1,000, $10,000, it just costs more. But it may be worth it to you, right?
Eden, what is the cost? I mean, I know the cost on a regular 1031 is typically about what, 1,800, something like that.
Yeah.
And then what is a reverse? Do you know?
I've heard people say like up to $10,000.
Wow. Okay.
I don't know why it's more. That's a little bit out of my, but yeah, I've heard that it's just a lot more.
So do they still have to sell that other property within that 180 days? Because that's as long as the intermediary will hold it.
Yeah, and that, yeah, so they can hold well, they will take replacement property for up to 180 days. So the new property is the one that they're holding title to. So that's a really good question, and I guess I don't know the answer to that. I'll have to find that out because yeah, you would need to know what your deadlines are, right? And I guess I don't know. Good question though, Karen. Does anybody else know that answer? On a reverse mortgage, what happens? How do your deadlines change? I'll try to find that out for you, Karen. Okay, so reasons for a reverse exchange, contingencies on the relinquished property not removed in time, no buyer for the relinquished property, prevent loss of the earnest money, prevent loss of financing commitment, locate replacement property first in a seller's market. So there are reasons why you would do it. I don't see this as much. Has anybody done one like this in their career?
I actually have one I'm working on right now where they have purchased the property, but they haven't sold their original property yet because they found one they wanted, but the one they are selling, they need to do repairs on. So yeah, hence
So
the
have they
question.
already talked to the qualified intermediary? Because if they've already
Yeah,
bought it, oh, okay.
they're
Okay.
working with an intermediary already, but
Okay.
yeah, I guess I need to call her and maybe I can give you some answers after I talk to
That would
her.
be fun. Yeah, that would be good. Okay, Svetlana says, sorry, my mic isn't working, but yes, on reverse exchange, you have 45 days to identify which properties you might be selling. And you have 180 days to sell one of the properties you identified. Okay, thank you. So we have a question. Victor says, in the event you buy new construction, what happens if the C of O is not issued before the 180 days? SOL? Yes. You have 180 days no matter what. So you would want to give a little bit of time, extra time probably on that one. And Svetlana says, and the cost of a reverse exchange is from 3,000 to 10,000 because you have to set up LLCs and there is some additional paperwork, which makes sense because the intermediary company is going to take title for that new property. Thank you. Appreciate it. Okay. Key takeaways. Purchase like kind of properties, even if they have an LLC already. That's a good question, Paige. Svetlana. Maybe she can answer that for us. Okay, purchase a like kind property, 45 days identification period, 180-day exchange period, purchase at equal or greater value, spend all of the cash, reinvest all of the net equity, debt at equal or greater amounts, do your research when choosing a QI, and reverse and improvement options. We didn't have a ton of questions, so we're getting close to the end here and we still have 30 minutes, but we'll see how we end up. Maybe we'll
I have
do
a
a Q&A.
question.
Yeah.
If I understand correctly, if you have a $100,000 mortgage on your relinquished property, then when you purchase a new one, you still have to have a $100,000 mortgage on the new one. Is that correct?
Correct.
And then in addition to that, all of the money that you're receiving as I don't want to say the word profit, but for lack of a better word, if you're making $200,000 on that property, then you've got to invest the entire $200,000. So for simple math, you would have to be purchasing a $300,000 property in that example. Is that right?
Correct.
Okay, thanks.
Yeah, because otherwise you have mortgage boot or cash boot, both, like you're saying. Yep. Good. Okay, remember, sign exchange documents before you close. Don't close on your relinquished property before unless you're going to do a reverse. The 1031 exchange rules allow you to sell your relinquished property to someone and acquire your replacement property on a later date from a different person. By signing exchange documents and following the other rules, you can take what you otherwise be a sale followed by a purchase and turn it into an exchange. It's essential to sign exchange documents on or before the date that you close on the sale of your relinquished property. Exchange documents include an exchange agreement entered between the real estate investor and the intermediary, an assignment of your rights under the contract to sell the relinquished property, and a notice to the buyer of the assignment on or before you close on the purchase. And then remember, you're going to have an addendum on either side that says you're doing a 1031 exchange. 3 big things: don't touch any of the money. Identify within 45 days of the closing date of the sold property what you want to buy, and finalize your transaction within 180 days. Buy enough replacement property to defer all the gain. We just talked about that. Think about expenses. There are some expenses that can be paid with the exchange proceeds, but you'll have to talk to your qualified intermediate about that. Not all of them can be paid. For example, brokerage commissions, escrow fees, some of those things can be paid with your exchange money, but just be careful because not all of them. And sometimes you have to come in with a little bit of your own money to avoid that. Think about safety. When you do an exchange, your funds are held by the intermediate until you use them to acquire replacement property. It's important to find out how these funds are held. Are they in a separate account identified by the name and tax ID number of the investor? Are they held in an FDIC insured bank? These are all important issues to address before you start the exchange.
One question I had on that, if you do investment properties and you put money into the property and then that money that you put into the property to upgrade it, is there a way for you to pull that back out now, and now you're going to use that cash to do that again? Do you know what I mean by that?
Yeah, no. Those are capital improvements though, right?
Yes. Yeah, they are.
And so like then they would increase your basis, and so then you could possibly end up, with a little bit, but anything you make above and beyond that would have to be put back in.
Okay.
So I guess so for example, if you buy a $300,000 house and you put 30,000 into it, now your basis is 330. And so your difference.
And then you go ahead and sell that house for let's say you sell it for 350. So you've got 20,000 that really is capital gains.
Right. Right. And the other 3, yeah, right.
So then I go buy a house that's 320, but I want to use the 30,000 to fix it up. See what I mean?
Right. And you can refinance and then do a 1031 and pull money out, the cash out, right? And then do a 1031. But yeah, so then if you sold it, yeah, I see what you mean. And I think, that your basis, your gain is what you have to replace into it, not, which your gain would only be 20,000, not 50.
Okay. All right. I can handle that.
Yeah. Someone comes to you with 50,000 and wants to invest. How much can you buy? What's the risk level and what's the liquidity? So let's talk about $50,000 invested in stock versus $50,000 invested in real estate. What would you recommend?
Well, I've always heard that in the long run, real estate outperforms the stock market. But even that, I think, is sort of a educated guess.
Right. So if you take $50,000, could you buy 2 properties with $50,000 possibly?
So my knowledge of mortgage loans, if you have $50,000 and you're going to need to buy an investment property, I'm not sure that's enough of a down payment to buy a non-owner occupied. I mean, I know there's programs out there, but if you need if you need 20% down, I don't know how that's going to be beneficial.
Right.
I mean, you could in a rural area. I mean, you'd still be highly leveraged, but
Yeah.
I mean, I had a friend, we bought one and it was in Memphis, Tennessee, on like the outskirts of town, and it actually ended up being profitable, but I was shocked that we were able to buy what we were with so little down.
So how can you buy an investment property with 5% down?
Can't you do a seller carryback possibly, or I don't know. Most people have more down than that buying an investment property. So 5% down investor property, that's a tough one.
Okay, so I only asked that because last year they changed the rules on multi-units. So if you're gonna live in a fourplex,
Yeah, it's
you can buy
different.
it for 5% down, right?
Yeah.
So that is a little bit different, but just keep that in mind when somebody like, because some of these kids are trying to figure out ways to get into properties, right? And that's a way sometimes for them to be able to start investing without having as much money to put down. So that was a new rule that was recently done. So I just want to bring that up. Okay. We do know that over the long run you're gonna make money on real estate, but it's not the short run. And so hopefully people understand that. One of the things that I like to talk about right now with people is, it's getting harder and harder for kids to buy houses, and for these young kids coming up, right? I keep thinking, how are my kids gonna be able to live in Utah, and how's this all gonna work? But all I keep telling my kids is save for houses, save for a house. A house should be your number one priority, higher than trucks and cars and all the fancy things that everybody drives around. I don't know how often I have somebody come in with $1,000 truck payment that's costing them $200,000 in buying power. And so I'm always telling my kids, I'm like, buy your house first, But it's important to educate, I feel like. Victor says we talked about having a mortgage of at least the same or greater than the new property, but what about if you own it free and clear, cash buy? Bought it for 200, sold it for 300, profit is 100K. New property needs to be more than 200K or 300K. So the new property has to be more than what you sell it for, the sales price. But then you have to reinvest all of that money in. So you don't have to have a mortgage if you didn't have a mortgage before. But if you're selling a $300,000 property, you have to buy another $300,000 property or higher. Does that make sense? Okay, any questions? I know we're a little bit early, so I'm gonna stay on for another 20 minutes, but tell me any questions that you guys have. Anything that I didn't answer that you wish I would have.
Have you given us,
Go ahead, Karen.
have you given us all of the keywords? Because
No,
I only have
haven't.
2.
We need 3 keywords. I know. I hate it when I get to the end and I'm like, well, I said everything I needed to say, but I didn't take all the time. Okay, let's do number 3, real estate. Number 4.
Say that again. Number 3, what?
Real estate. Let's do number 4, investing. And number 5, my name, Eden.
What's 5 again?
Eden, my name.
Questions?
Yeah, please, Tom.
The survivorship of the property, if you give it to the kids, do you have to die in order to transfer that, or can it be done prior to your death?
You have to die.
Okay, I'll take care of that. Okay. And
Yeah,
then do we,
because then they inherit the current market value
okay, cool.
as their basis. Mhm.
Then do we have a source to get a copy of the graphics that you presented?
Sure, if you want to just email me, ejohnson@Security Home Mortgage, and just say, can I have the slides? I'll send them over to you.
Okay, thanks.
Yep.
So do we give you the 5 keywords to the same place, the same email?
Yep, you can do that too. Yep, you might as well just send them to my email, or you can do the QR code too.
Okay, I got both. Okay,
Okay,
thank you. Good job on your presentation.
thanks. Sorry it didn't take as long as it usually does. I don't know. It's so funny. Sometimes we go through the slides faster, sometimes than other times, but
I've got one comment. I've maybe done 7 or 8 1031s, and a lesson learned to share with anyone that
appreciate
does
it.
them is when we talk about giving legal advice or CPA accounting advice. I'd sold a client a property, and a couple of years later we went to do an exchange. So I used, because I handled it, I used what he paid for the property and his costs. But what he didn't share with me, because when I went to list it again, there wasn't a whole lot of remodeling or improvements done, but yet he had turned into his accountant a lot of improvements and upgrades that I wasn't aware of. And so we entered into the exchange. He paid at the time it was $1,000, and we closed, and everything went great. And the accountant called me and said, "Why did you do an exchange?" And well, it looked pretty straightforward. And the client had claimed over 150 to 100,000 improvements that I had no idea he had claimed on that property on his basis. And so I laugh when I hear, don't give advice. I like to give some advice that I know is not going to get me in trouble. But yeah, the accountant let me have it. And my client said, "Hey, I didn't know I needed to tell you that information." And because I went over there, it didn't look like anything had been done. So just that's an experience I had just to share.
Well, and it's interesting that he was mad at you because you wouldn't really know any of that, like basis stuff, right? Like as the
No,
real
yeah.
estate agent.
And my client had 7 or 8 properties, and he continues to have that, but he just didn't like this location and the property. But so I sold it to him 2 years, 3 years later. I went in, nothing had been done, in my opinion. And whether or not he was submitting expenses from another property, I don't know. I stayed out of it, but man, I got lectured from the CPA. And all I said is I was unaware of that. So they had to recalculate a few things, and I think he submitted an amended return. But I learned that day to make sure I ask, "What have you done for improvements? And let's make sure we're on the same page with your accountant on what you've declared as costs or improvements to your property." And that was, I'll never do that again. But getting a general idea, or hey, have your accountant start preparing this. And actually, I'm listing another one for him. Same thing. I sold it to him. I went in yesterday, and it doesn't look like much has been done, but I'm going to stay out of it so he can deal with his accountant.
Yeah, I mean,
And not
because
me.
to me, it seems like that you would have your accountant giving you your basis and
First.
your gains, right? And then that would be sent over to your QI. And then, yeah, I'm surprised the accountant was mad at you. I don't know. I don't see how you have any. Somebody says they want to do a 1031 exchange. You're like, okay, is this an investment property? How long have you owned it? Okay,
Yeah.
we talked to your QI. Yeah, interesting. So
Yep.
be careful.
Got lectured.
Yeah, got lectured. Okay, not fun. Sometimes we have to deal with people who are hard to deal with. There's no question.
Well, and the only fee was I was almost willing to pay the fee. It was $1,000. That's really what he was out. So we didn't declare anything on the sale. It was just that fee with the QI that was a little bit of waste of money because the taxable gain was
Because he
teeny.
couldn't 1031 exchange at all.
No, because his basis was more than the gain. So he was in at like 600,000. We barely sold it for that. And I
So
helped
he
him buy
didn't
it for
need to because
Yeah.
he didn't have any gain. I see what you mean.
Yeah, so there was hardly any gain. I think it was like $400 when all was said and done, and he paid $1,000 in the QI fee. And my agreement with him is, hey, we'll reduce that on the next commission or sale or something. And he said, no, that's my fault. I didn't tell you. And my question is, well, so tell me what you did to the property.
Well, so that makes a lot more sense to me. If they're not gaining anything, there is no reason
Yeah.
to do a 1031 exchange.
Yeah, apparently it was a really nice tough shed somewhere in the yard. I don't know. Oh, and a garage door opener.
Gotcha. Yeah, right.
Yeah.
Right. Well,
David, is this 1 or 2 hours of credit?
it's 2 hours. That's why I'm like 20 minutes early because we cut 10 minutes off per hour for a break. You're allowed to do that, but I'm still like 20 minutes early. So it's supposed to be 2 hour. Sometimes we just talk more and have more questions.
Okay, so if we hang up early, we're not going to get penalized?
Correct.
I mean, I've been loving the conversation. You did a really good job on this.
Thanks. I need more slides apparently sometimes just in case we don't have as much conversation.
No, there's nothing worse than, well, in this context, there's nothing worse than trying to get these CE credits for your license, and that 30% of the presentation is, the class clown or the jokesters or the wasting time with irrelevant or superfluous information like I'm doing right now.
Well, I appreciate it. Yeah, I'll still stay on if anybody has any more questions.
Eden,
But yeah, go ahead, Wesley.
I would have another question. It's not related directly to what you presented. It's in regards to, I have a potential client who's going to become a teacher, and they will be a first-time home buyer. Do you know of incentive programs for teachers to help them get into houses and also like first-time home buyer type situations?
You know what? I wish there was something for teachers because it seems like that would be a really good thing. We have stuff for policemen, but not for teachers. I don't know of anything. You'll hear, so one thing I came across this year, I have somebody who went under contract and they make too much money for any of the grants, but they're a first-time home buyer and they were just trying to find anything that could help. And they came across the Homes for Heroes. I don't know if you guys have seen that. But basically, the Homes for Heroes is a lead generation system. So it's not a true grant. It's basically, I mean, correct me if I'm wrong, but from everything I can see, it's the agents that are working with the Home for Heroes give a little bit of their commission. The lenders who are working with them give a little bit of their commission, and you can get up to $8,000 that way. So I told him, I said, I'm giving $2,000 to the deal. You can ask your real estate agent if they want to give any. But in my mind, like you've already signed with your real estate agent. And so, the Homes for Heroes is more for police officers and, people like that too. So when I find people who are like, for whatever reason, don't have anything else like that, and especially teachers, I usually work with the agent to try to do something that we can do to help them. But I don't know of anything specific.
Not necessarily through the lender, but with the agent and stuff. Yeah.
Well, I try to give them, like I just closed for a teacher and I try to give them money off as well, but and do the best I can to help them. But yeah, I don't have anything that I know is specifically related to educators.
Okay, thanks for that.
Steven said, I bought a property last year for $660. I spent $60K to finish the basement. Now it sells for $900. Does it count capital gains on $180K? Yeah, so if you added the $60K, that's part of your basis. And so, because that would be like capital improvement to finish the basement. So 660 plus 60. Now your basis is 720, sells for 900,000, 180, right? So 180 would be your capital gains instead of, right, if you didn't keep track, but you would have to show that to your accountant, right? You would have all the receipts or like a contract with your builder or whoever did it. And you would have to show receipts just like anything else when you're doing accounting. But otherwise, right, then if you didn't keep track of that and put that in, then you're paying taxes on 240 instead of 180. So good question. For those of you who are still here, this isn't necessarily capital gains stuff, but while we're sitting here, one thing I always like to talk about is things I've learned recently. So, for example, being careful of deadlines and working with somebody to make sure that you're early on your deals. There's nothing more stressful than getting to the end of a transaction and having something come up that you weren't planning on. And so I always like to make sure that we're done out of underwriting approval before our financing and appraisal deadline and a few days before so that we make sure that if anything comes up, we have time to deal with it. I don't like being at the end of a deal and being stressed out. So another thing that we were talking about that sometimes we have clients who aren't really helping us with our deals and getting everything to us. And so sometimes we might reach out to you as agents and say, hey, I've reached out. They're not getting me stuff. Can you help me express to them how important it is to get documents over? But deadlines, just like with 1031 exchange deadlines, any deadlines are super important. We want to be super careful.
Eden, I have a question for you.
Sure.
A couple of months ago, I dealt with a customer that father and son. The father had owned the house for, I don't know, 15, 20 years, ended up moving into a new house himself, the father, and let his son live in the original home. Now the son wants to sell the house and move into a new house himself. I told him, wait, there's probably some capital gains and some stuff that we're going to have to deal with your father. How can we get around that to not have to do a 1031? Because the son wants to own his own home, not have something else under his dad.
Yeah. So I don't know how they hold title. So if the son's on the title, then it's a primary for him, right? If he's not on the title, he's just living in
He's
his
not.
dad's house. So he's
Still
not
the
on,
dad's home.
yeah. So his dad's gonna have capital gains when it's sold. And they could work that out themselves, right? Who pays for it, how that works out. But the dad,
Is there any way of titling it differently so that there's not, or no?
I mean, even if he gives the house to his son, he's not passed away, so you wouldn't have the inheritance basis that you would have. So that's a good question for an accountant, probably, but in my mind, like just off the top of my head, I can't see a way for somebody not to have to pay capital gains.
Gotcha.
So if the dad's kind of giving it to him and signs the title over to him, then he's lived in it for how long, do you know?
Many years.
Yeah. So then it's a primary and he could exclude the gains, but
But would it be 2 years after he titles it to the son, or could it be retroactive?
right, I think it's 2 years after he titles it to him because he's lived there for 2 years, but it hasn't been in his name.
Right, yeah, exactly.
So that's a little bit complicated, but like if the dad's saying, well, you can sell it and have the money, right? And then the dad says, well, you can sell it, but you can have all the money minus what I have to pay in taxes.
They just don't want to pay the taxes.
Yeah, nobody wants to pay taxes. I love that. I feel that. I don't know any way around that, but but a tax accountant, a CPA might know some loopholes that I don't know.
Okay. Oh, that's fine. Thanks.
Yeah. Good questions.
On that one, I think just defer the taxes out for as long as you can, and then have a trust or will that just says ownership chain transfers in full possession to my son later on.
Yeah, so he'd still be under his dad. His dad would still technically own it.
Yeah, just to maximize the tax benefit. I mean, it's a conundrum because I understand he wants to be independent, but at the same time, too, is that worth it when eventually, I mean, as long as you spell it out early, too, in a trust or some kind of inheritance document, ownership becomes his regardless. So,
Right, right.
I mean, unless he wants to use the house, as a collateral for something, that one's interesting. It would be tricky. Hey, great class, by the way. I'm going to cut out.
Thanks. Good to see you.
You too. Take
Steven,
care.
you too. Stephen, you said if I keep this property 1 more year when it reaches 2 years minimum, so the capital gain won't apply when I sell it, right? If you live in it. Is that what you were asking? Yes. If it's a primary residence, yes. And I mean, the capital gain applies, like if you're single, up to 250. If you're married, up to 500, you can exclude. So if you're making more than that, then you still would have some capital gains. Okay, well, if anybody doesn't have any other questions, I'm gonna go ahead and go. Happy Friday. It's my favorite day of the week. Yes,
Hey, I have a question, but I want
Please.
to everybody. I
please.
don't want anybody sticking around for this because I may be the only one that doesn't know. It says, or fill out the form with this QR code. So what do I do?
So if you have your phone, you can open your camera and scan that QR code and you can click on a link that will show up when you scan that QR code.
Okay, I did that.
And then you just fill out that form that comes up.
So then I click on that. Okay.
There's like a yellow link that you
Yeah,
click on.
okay, I get it. Got it.
Yeah, thanks. And then you
Okay,
can just
thank you.
fill that out. But yeah, if anybody wants the slides, email me. I'll send you a copy of the slides. I'm happy to do that. And as questions come up, feel free to reach out to me. I have some good qualified intermediaries if you want some names of people that I've used in the past and that I feel like are good, reputable. And so I can send you her name. Her name's Angie Watson. But yeah, like anything I can do for you, please reach out. If you haven't met with me or had lunch with me, Thomas is my marketing director. He may reach out to you and invite you to lunch with us. Feel free to let him know if you work with other lenders, but if you're interested in meeting with me and getting to know us better, we'd love to get to know you better. And we hope 2026 is your best year ever and ours too. So have a great weekend and let me know how I can help.
Thanks so much. Appreciate it.
Yeah, we'll get these hours banked as soon as we can. If you don't see it, let us know. We're happy to, hopefully everybody's gets banked. But yeah, every once in a while we do make mistakes. So just give us a call and reach out. Have a good weekend.